Right? What are you guys doing here?
Aaron
Oh
takes
my gosh.
all your stuff
Sorry.
together.
I was trying to, get my my social medias updated with the new profile picture and stuff.
All right, you have an excuse. What about Josh? No.
So I now have to work. Is that what you're saying there, boss? I got to work.
Where's your selfie stick? We invested in one. Come on.
That's
No.
yes. Get your setup, man. Actually, Josh is improving his setup every week. It's great. I'm Darren with Arbitrage Trade. This is After the Bell, and it is Wednesday, so we're after the bell on the proper day of Wednesday. My guests are not Daniel Hopwood. He is not here. The Singapore Institute is closed, and it's off on vacation. And we do have, however, our other two normal folks, which is Josh Morgan, a.k.a. JPM, a.k.a. JP Morgan. And then we have our boss at the bottom, the one that makes me work and makes me get away from my selfies, and that is
you
Royce.
shouldn't be doing selfies, at least not while we're recording.
I mean, I am dumb money, and so I might as well be dumb on everything else and do that instead. And hang on, I got something here. Oh, throw poo. All right. Disclosures must be said. We are not financial advisors, and this is not financial advice. This information provided is surely for educational and entertainment purposes only. Please always consult an investment professional before making any financial decisions, or just simply have our AI bot Pips do the work for you. I added that one. You like that, boss? All right. So
I do. Plug it more.
There you go. So let's talk about the where we make our money from, which is the stocks and foreign exchange, etc. The tail of the tape, we start off at the top of the show every time. So let's start off with the big news this past week, which is the stock crashed this last week.
It wasn't a crash.
Friday,
it was more
right?
like
Okay, we're going to get color here in a minute. I'm just going to set it up here, though. But it's been called the yen carry trade. So a lot of people don't know what that term means. So if you would, Royce, tell us what yen carry trade is all about.
Well, they're blaming on a lot of things. However,
I got that coming, yes.
However, this was inevitable. The yen has been basically moving the wrong direction, and I say the wrong direction because I wanted it to go down. Basically, every other pair versus the yen to go down at least since mid to late 2022. So, yay, some relief. But a lot of this stems from, at least in my personal opinion, Japan finally getting a positive interest rate. They went from a negative interest rate to just a 0.1, and now they're at a 0.25. And basically, now Japan, instead of paying people to hold their money and take their money, they're actually charging people that they've lent their money out to. And now basically people are like, well, you know what? If you're charging us, here, you can have it back. So mass exodus, countries across the world, just like, you know what? Let's get rid of that. And Japan also divested almost $22 billion of its reserve USD. So in that push and that interest rate change, everything versus the yen face planted pretty much because they came out swinging.
Right. So it's being called the Great Unwind. And I think that's because you have countries that always went to Japan for money, right? And they would spend there because it was cheap or
it was beyond cheap. It was negative. They would actually pay them for taking it.
So please take our money. You know, that meme. Please take all my money. It was basically that. And now, where are they going to go now? Because Japan and Switzerland evidently were the ones that everybody went to get cheap exchange. And like you said, make money off of it. So, I mean, is still the cheapest? Or is it going to be someplace else to go?
It's definitely not the cheapest.
Okay.
If I had to put someone that's not a reserve currency, but that's very close to being a reserve currency, believe it or not, New Zealand versus Australia. Those two are neck and neck trying to be the cheapest and most traded Forex pairs, besides obviously anything versus the dollar or the euro.
Interesting.
Right?
Okay.
So
Australia
and because of that, a lot of tanking. Like literally, if you were watching GBP JPY the last 15 days, over a 3,500 pip fall in the last 15 days.
Oh.
So it made it all the way from 208 all the way down to 188.
Gotcha. And dollar's creeping back up above 103, I think now. Right?
And remember, I told you that the dollar basically has to take a hit. It has to advance, but it has to advance slower than Japan for the scenario that basically that Pip sees coming for it to work out like we see and plan for.
Gotcha. All right, we'll move on to another big news item this week, which was, they've been talking about it for a while. Congress has been on top of it, so to speak, Department of Justice, etc. But Google and their fight with the Department of Justice. And so a ruling came out. The judge said, yep, you are being hey, say it for me. Monopolistic?
You are a monopoly.
Yeah, let's just say you're a monopoly.
Yes. You are Boardwalk and Park Place. That's not allowed.
Thank you. Yes, and I play that way too much. There is basically in the umbrella of antitrust, and that's what's happening with it. They've gotten too big for their britches, if we want to really dumb it down, and that they spent a lot of money to get in that position and to make themselves basically in trouble with antitrust laws. So they're appealing, of course.
Are they?
There are a lot of contracts written up, like with Apple, with other, like every time you buy something, that's the default. It's the default search.
Understood. But for as much as AI has been taking the forefront, basically AI becomes a direct competitor with Google and Yahoo for search, because instead of going Google it, you're going to ask ChatGPT or whatever version of AI that you're using, hey, tell me XYZ.
Right. Every browser's gonna have their own AI. So it'll be a matter of which one you want. And that's the thing, is they just want to make it more open to where it's easier to choose which one you use, because I've tried, that's a rhyme. Because I've actually played with other ones.
That time.
Thank you. Yeah. I've played with other ones, and it's hard to make it your default, and you have to go all the way into settings again. And it's every time you update your phone, it defaults right back to the old one, and you got to go right back into your settings. And I mean, it is kind of monopolistic, if you will, just because I don't say that word much. So it's a good chance. So come in here, Banker. You got something you want to say there? I can tell.
Well, I was just gonna say, I mean, that's really like the crux of the argument is Google has spent, let's take Apple specifically, and I'll branch off into that point. But they pay Apple $20 billion per year to make them the default search engine. And then to your point, they have done, they will deny it. They have said that, there's other reasons for it, but they have made it more difficult to get a different option. And that because there is no other really good option. I mean, like DuckDuckGo is fine, Bing is fine. I think Safari has their own, but even despite the fact that Safari having their own, it's still, Google is paying hundreds of billions of dollars to all of these various companies to be the default search provider. And I mean, there's nothing more monopolistic than that.
Well, they've done some good too. Have you seen in the latest version of Chrome release?
Well, that's the counter argument, is that what Google is saying is that they own 90% of the market share, and the rest is split, between all of these other search engines. They get to divvy up 10%, and Bing has, I think, like 3 or 4% of it. So you're looking at everything else is divvied up in 6% left.
Yep,
a little bit less because there's extra percentages on the end, and they are arguing that we are the best search engine, and there's no denying that. I mean, it is they are synonymous with search. I'm going to go Google something, and so
they made it a word.
I certainly get it from both sides, but
it's a verb. Yeah,
the only thing that's really and to really sum this all up, the only thing that's actually going to happen from any of this, it's just going to get buried in litigation for the next 10 years. They're going to end up not paying these companies to do that. They're still going to take 90, they might drop down to like 80% of the market share, but it is the best product out there for searching. Like, yeah, you can throw AI ChatGPT, whatever, but ChatGPT is not going to give you YouTube links or images or any of this stuff.
It can, though. If you ask it, it can.
It sort of, kind of, and yes, eventually it will be something that is significantly more competitive, but it also, pulls results from like Reddit. And I don't know how much you've delved into Reddit, but there are some dumb ass.
There's some dark alleys in there.
Whatever. So I mean, like I feel like Google is providing the best search results, the most trusted search results, and I think that's built on what they've done and the product that they've developed. What they've got to stop doing is forcing it down our throat.
Well, I think anytime you have a monopoly, you also have a very easy time to control information, and that's a problem for me. So if you have one company that's like you said, 90% of the info that all you got to do is put whatever info you want or whatever agenda you want as the result of those search engines, and you can control information, and even if it's wrong or right. And so now we have the AI. It's the same issue. You don't know if it's wrong or right. You have to double check it. It's just it's a very dangerous time right now, because I mean there was some examples lately. By the way, Elon Musk is looking at his own search, of course. But
you do know that Google is not a search engine. I mean, yes, they do search engine, but that's not that's not where they make their primary money. They make their primary money from selling the data they collect. That's what ABC is about.
No, that's right.
Yeah,
right.
Their primary source of income comes directly from the data that they can sell back to people.
That's their income, but
and you know where they get that data.
It is still the biggest and the most known search. And
yes, they also give it out, but they also sell it, right? So while the search engine, yes, it's a search engine because it has lots of sources, lots of nodes, their primary intake is not from what they search, but from what they sell, from what they've collected and what they've correlated. Just like, I'm not sure if you guys remember when COVID first came out, you had the tele-doctors, basically. So they basically set up an appointment on the phone. The $15, $20 doctor visits, those were nothing. You know why? They have your biometrics. They have all of your data. They make their money from reselling your data.
Mm-hmm. Mm-hmm.
The best business that you could ever be in is one that has no inventory. So basically, Google figured it out on the front end, and then they had all these clowns following, just collecting data and dispersing it at willy-nilly and making money.
Well, that's been the narrative, of course.
Yeah, it's always that old adage where if you are using a great product and it's free, you are the product.
Yes, absolutely.
Yeah, it's just a part of Google. You're right, and that's been the narrative this morning on Financial TV, is that no, don't sell it, because that's only just their search engine, which is responsible for very little. My problem, though, is, like I said, is when it comes to the search, it's what everybody uses, no matter how much money they make off of it, and therefore they can control information, and I have a problem with that. So I think that's what Congress also is trying to get at too, is that it's just there's just too much power being given to them, whether it be disinformation or correct information. And we'll kind of leave it there and move on to the next thing, which actually just popped up. I saw today, which is that BlackRock, here they are again, Mr. Fink, is involved, and NASDAQ, the whole exchange, is involved in trying to have options now for Ethereum ETFs. And the first time I hear ETFs, it's all about control, whether it's actually with the product or not. It's there's going to be ghost things happening here again, and it's just a matter of getting control of it. And Max Payne is going to come back into this, and it's just going to be a market maker.
You know why they want option contracts?
Besides controlling the price? I don't know.
Absolutely, besides controlling the price. The mechanics, why a company would offer option contracts. This is a very, very good thing. Like, so basically, when you have shares of your stock, basically you're employing people to invest in your company, right? When you have options, you're also basically, without risking more of your company, you're giving them the option to buy your shares of stock, or letting them basically have a downside protection where if they basically are buying or selling, depending on what they're doing with the option, whether it's a call or a put, if it starts to fall with the option in place, it's downside protection. So like, for example, if Ethereum's at 3,300 and you have a 2,700 option and it gets to 2,200, guess what? Whoever just picked it up is down $500. So basically, it allows basically the company to hedge against their own stock to make, or ETF, whatever you want to call it, to make sure that they don't lose money and they're able to sell premium and basically pull it from anyone who wants to buy. It's like, hey, this expires Friday. You want one? I could mention a Matt Rife concert, but I won't.
We name drop every now and then in here. I just options in general, though. Anytime I hear the word options, I think of manipulation, and that's the way it'll always be for me. Is that they will be able to manipulate a price wherever they want it to, and that's where I have the problem. Not the company making money off of the options, but the funds making money off of people.
Well, it's
where I have the problem.
And it's sort of like if you look at it like you own a house, right? I'm going to do another analogy with this. Every week you can rent it out. Without options, you have to sell your house. So in order for the company to basically get a premium from whoever wants to buy that equity, that ETF each week, without the option, they don't have an ability to leverage their position or the money that's tied up in that position to potentially use it someplace else. So while yes, the price will definitely fluctuate. That's the word. Fluctuate with market volatility. The end goal is basically, we know that options are a decaying animal. We know that premium will wind up back at whoever the person who owns the stock or ETF has. But without it, there's no downside protection to allow them to basically roll them or even do next year. Like, for example, I know you guys are, you particularly, Darren, don't like with extra floats out there, right? It's like you only have this much and then there's all this. Well, with options, it allows you to also say, I'll give you an IOU. I will buy an option 3 years out and then sell the option using that as the collateral. So I don't actually even have to own the stock. I literally just keep renting out a house I don't even own and getting a premium every single week as I sell it.
Yeah, and I mean, options it's like an unlimited way to continuously trade the stock, because there are, without offerings and things like that, there are a finite number of shares. Yep. And eventually all of the shares get bought up and you get the squeeze. Yep. And that's how it should work fundamentally. But then you throw options in there and traders can just play options. So it's almost like imaginary. It's an imaginary version of owning those particular shares. Yes. But you don't actually own them. You're just borrowing them for a couple of weeks. Like to your analogy. But
you do have the option to exercise if you so chose.
You can. Yeah, you can. And
more fake shares be out there in the market. Yay.
It'll eat up.
They can't just make them up. That's where the market makers come in.
They make them. The brokers keep it's rehypothecation over and over and over again, and it's the same share being rehypothecated 18 times, and the float being 18 times the float, and so there never is any type of accountability in that situation. There just never is. And the more money you have,
definitely is. And
the more money you have, the more you can control that. So I mean, anybody that doesn't have the money, you're not going to be able to control it. It's going to always be the funds and doing what they do. So
I mean, there's always a much higher risk with options because the value can literally end up being zero if you get to expiration date and you haven't exercised it, or it hasn't increased in value, or you can't sell it. If you get an option where you're on Thursday or Friday right before expiry. I've done it many times where you get right up next to that deadline and you try to sell it and it's worth nothing. And
because all the delta is gone, all the time, time efficient, and the intrinsic value, basically how much it's really worth versus the extrinsic value, which is the perceived value that it could be worth based on how much time is left, basically completely deflates. And you're only left with the intrinsic value, which is, hey, a penny, 2 pennies, $1, $2.
But if you catch it at like the right delta and theta area, the ROI is exponentially better than just
Oh yeah, of course.
just
Yeah.
buying
Yeah.
just buying a couple of shares.
Hey, and you know this works really well with statistics and probability, right?
Mm-hmm.
All right, just to wrap this section up, the only thing I'm going to say, of course, is that ETFs and options are just they increase the house odds even more because they can control anything and everything. So
that's what we're taking away from that.
if you're not, that's what the ape is we've been saying for 3 years now. As we've watched every Friday, it get down to that max pain point, but we've said that before in previous ones. So let's move on to the is the rally for real? I made it big. And of course, we might have had a little clue this afternoon because the stocks went from green this morning. And now they're dipping just a little bit. They're teasing red. So I think it was like the Dow was down 0.6 at the close, S&P 0.72, and NASDAQ was down up right at 1%. So I think it's interesting that we've talked about this before about how everything's spreading out, but the NASDAQ's the one that's jumping way up and way down every time. And I think it's
I got some good news and I got some bad news.
Go for it.
I am wearing the hat today. I am wearing the hat. So
this should be good. This should be good.
Well, the NASDAQ, right? So basically, I'm saying that it will not get back past 452. Not this year. Not this year. It's creating an Elliott wave, and basically the weekly chart right now is in charge of the trend. And with that being said, everything that's going on right now will fit a narrative that you guys will see unfold in about 3 to 4 weeks. Mark my words. In order for us to get this rate cut that the Fed wants to put out there, the market has to go, woe is me, we really need it. And then once it's sad enough, then they'll cut the rate.
Yeah, but that's kind of worst case scenario.
No, that's best case scenario. The Fed has no obligation to cut the interest rate unless the economy is not moving. So if you start to basically punch holes in the NASDAQ, the S&P, and basically all the other markets, all they can do is say, hey, we need people to spend money, cut the interest rate, make it cheaper for them to borrow, and hope that they do. Because in the last, after the bell, we talked about it being like flat 0.25. That's not really a cut. That's a non-cut, in my opinion. So if you want a rate cut that's more than 0.25, like 0.5, you have to put on a real serious mask and nice, charade to say, hey, we are hurting. Please help us.
I mean, there's a lot of, I mean, if you start getting into like why they're cutting rates and if it's because of the economy's getting hurt and people are starting to panic, and they, if they do like a 0.75 basis points cut, something like that,
that'd be amazing.
I mean, that's gonna have ripple effects all over.
It'll be bad. Yeah, it'll be bad.
Absolutely will. And I mean, I know this correction that we've been calling for forever, it will certainly almost usher that in. But if the Fed does that, then this whole golden path and soft landing and all of those other terms are basically completely out the window. The Fed their hand has been forced, and to me, that's kind of the worst case scenario, because it is going to have widespread effects across the market and across the economy, and it could ultimately end up ushering in the global recession that that word seems to keep popping up.
That's already started.
So how else would you see it play out then, Josh? If you were the Fed and you had the ability to cut rates or not cut rates, and you saw the market going down, and historically, the only time they have ever cut rates was when the market had fallen 10 to 15%.
But to me, this is not like this. What the couple of days on a couple of bad days in the market is not a reason for the.
I'm not counting the days. I'm counting the percentages. So the S&P went from 560 or 570 all the way down to 510-ish.
Yeah,
it was about 10%, almost 10%.
Yeah, it's almost a 10% cut in literally less than 2 weeks.
Mm-hmm.
So if if this continues, and let's say we make it to mid-August, maybe early September, and we lose another 5%, that will give them justification to say, okay, yeah, give them what they want, give them the rate cut, and that way, they keep their word. They did have one cut this year, and now we're ushering in a new president. And everyone goes, yay, new president. Let the games begin. We've dipped, so now we have nothing but room to grow because volatility has expanded from the sharp down. It makes a higher ceiling. That's just how probability and statistics work.
I mean, I get that. It's just, if they're really trying to get, if they really want the narrative to work out that like, hey, we handled all of this perfectly and correctly, and they really need to, continue to steer towards that, soft landing and the golden path and everything. And I know it was a seriously red day, and 10% is a pretty big number, but realistically, I would think you'd have to get more into like the 15 to 20% before the Fed would have their hand forced. And especially
on that,
even weirder, for this to happen in August in an election year. August are typically in an election year, they're not the typical August. They're actually pretty decent.
Yeah. So another cool fact, because I like throwing facts at this thing, right? That 10% that it fell, that $60, if you move that back to 2008, the Dow and the NASDAQ and S&P 500 fell about $60 in the 2008 correction. So that 10%, if you basically just compare it to the dollar amount it fell in the short window, it took a year and a half for it to get there. And 2008, it did in 10 days here.
Yep. There are a lot of mirrors still with 2008. So we keep coming back to that. And I feel like this whole Japanese yen thing is just a little small part of it, and it may have been like
out of proportion. Yeah,
I exactly. And I've got some narratives which I've heard over the last, which you'll love with me, is some different narratives that different media outlets have used, and it's funny because there's a ton. So anyway, to me, the yen was the actual beginning of. Like the beginning of the unwind. It's like this is all planned out. Somebody somewhere or a group of people somewhere go, okay, this is what we're going to do. We're going to do this first, this second, this third, this fourth, the fifth. And it's just execution of a master plan, because I have my tinfoil hat. And so do you, Royce.
Yeah. Oh, no, so go ahead.
I was just going to give the media narratives, but if you want to add something to that, go ahead.
No. The only thing I was going to add was basically, I just want to know, like they talk about a golden path, a soft landing. What does that look like? Like they're like, we're trying to do this, we're trying to do that. I'm like, so what's your end goal? Where does it say, oh, okay, the market's going to continue up, it's going to be slower than usual? Is that the soft landing? Are you guys basically just going to hold the interest rates at a certain rate for a few years? Is that the soft landing? What's the end goal for this golden path / soft landing?
Oh, that's a great lead in, because I mean, the funds also are in on this, the funds and the media, because the funds give the media money to anyway. They also played with, I don't know if you remember that. Well, you don't watch media, which is a good thing, but they played also with the no landing. They said that for a couple of months, and that made me throw up over and over, and I had to clean it up on my carpet at home. It was ridiculous. No landing.
Sorry about that.
So, yeah.
Carpeted basement.
Okay, I had to clean off the tiles over here.
In the basement.
Because you have to keep the noise down. All right, so because I have wild parties down here. But the media narratives that I heard over the last few are, of course, the yen, the carry. You had the risk sentiment improving. I heard that one. To say that what you saw last Thursday and Friday was just a little blip. It wasn't the real thing, because risk sentiment is improving. People are actually going after more risky things now, which they say that one over and over again. They also said that global turmoil has eased. So all of a sudden, there's no such thing as Russia, Ukraine, and there's no such thing as Iraq and U.S. and Iraq and Israel. Everything is easing now. They also, Japan jumped in today to be part of a jawbone, which is in my 3 things for tomorrow. jawboned the fact that they're not going to take any more rate increases if there's turmoil, so to speak. So that eased everyone. That was supposed to ease everyone. They're jawboning now.
And next thing you're going to say that you have Iraqi dinar that's going to be worth millions in a couple of days.
Dinar, there you go. Dinar is who? Which
That
country's
Iraqi
dinar? Iraqi. There you go. Okay.
I think it was Desert Storm. Basically, once they rushed in, their money went to basically zero or practically zero in 2003 and hasn't been back since.
Yeah. So then another one. I'm not done, of course. I have a list. Corrective mode. They're saying this is a corrective mode. That 10% is what everybody planned and knew was coming. It's healthy. That's right. It's a corrective mode. And then there was, and we're just waiting for the market to prove itself. I mean, some of these, like I said, I got really sick in my throat. And then honestly, some were just saying, we're just going to wait for more data. They've been saying that for 3 years, right? Right after transitionary, it was all about, it's just waiting for
Google,
data.
They have it.
That's right. And then, of course, they're saying it's the data that's important now, which that's a moving target, is the employment report. So now it's what are the next employment reports going to be? Because remember, that's when they said everything went downhill is because of the last employment report that happened at the end of the last week. So it's just narratives just everywhere. It's what is that? Narratives everywhere.
Yeah. The only thing, in my opinion, and this is talking as an economist, no other hat on, is GDP. Keep your GDP higher than everybody else's, and you win.
Gotcha.
No matter how many people are employed or not employed, as long as your GDP is higher, better, and it's not negative, you win running the country, whatever the country.
Yeah. As long as they're correct GDP numbers and they're not just made up ones, but I won't get into that again. So gas and oil was up 3% today out of the blue.
Yep. Mm-hmm.
And guess what the media says is the reason why?
Oh, what's that?
They said because of the OPEC cuts, which happened how long ago? And the Mideast tensions are easing. So I have a problem with that because the price was going down when the OPEC cuts were happening and the Middle East was easing. I mean, it's just I'm okay. I'm not going to go to make it a whole day of media, but we do know that the media is controlled by 6 different entities, right? In some way or another. Most of it is. So it's absolutely crazy.
I will not get canceled. Next subject.
No, we are media. We are media, right? Small media.
It's trying its best to get us canceled.
All right. So just a little touch on that. Then we're going to the macros. Is Iran, Israel a thing or not? Or is it just a event that's out there to justify why the stock market's about to go down? I mean, what is it? I mean, I don't know. I don't trust anything I see anymore.
Well, I mean, ironically, your last 2 points are kind of related. When you start getting into like Middle Eastern turmoil, like WTI and oil rates typically go up. I mean, I know we've had, I think WTI is coming off like a 6-week low, but when you start getting concerns about the Middle East and like Hezbollah and Israel and everything over there, and then, Russian concerns over, supply. And then if you look at the inflows of the supply, everybody has been stocking up. So there is a real consideration of some sort of situation in the Middle East.
Hello. That's the politicians calling. Saying
no, that's what symbol is that? Oh, that's AUD going into a cell. We like that.
Oh,
okay.
There you go.
All right.
Instead of people loading up on AUD.
Bye, Australia. You heard it here first, folks.
We're not going to go back to our foreign exchange section, but hey, there's a teaser. But yeah, you're talking about, but see, the thing is, the weird thing over the last news year of the last year or so is just that hasn't affected. It's like they're not attached anymore. It's weird. The gas oil thing is just weird.
No,
and we haven't. The U.S. isn't stocking up because we're getting lower and lower in our. I mean, I just don't know what's going on. I don't know.
I mean, go back and look historically.
It's here to ask questions.
When we start getting concerns over, not even just the Middle East, look at what, going back to your point about Russia and Ukraine, when you look at what happened with energy prices and like natural gas and crude oil and clean energy and all of that, like this prices shot up when the Russian offense escalated against Ukraine.
Don't forget about wheat. That was a big one.
Yeah.
Yeah.
Historically, energy prices do tend to mirror any kind of concerns as far as global safety and military events and things like that. And, I made that point a couple of days ago about how that the Pentagon index has suddenly spiked the last couple of days,
well, what I'm getting at is the turmoil across the world right now, and the fact that it's going to affect every economy around the world if in fact everything that's being portrayed out there is happening. If you look at UK is going through some stuff now. They got a bunch of cities that are going through riots now. You've got, like I said, the Iran-Israel. You have our troops were attacked in Iraq by Iran. So we're supposed to be responding to that still. You have the Bangladesh prime minister. I misspoke in earlier in the week, but not the Indian, but the Bangladesh prime minister escaped to India because of their how do I say it? Authoritarian. I'm messed up today. I can't even say monopolistic. I can't even say that right. Phenomena. But all right. But my point is, it seems like everywhere there's stuff happening around the world, and it just seems like it's happening here in the last 6 months a lot. And so is that what's building now to this huge 30% off the stock market? And then the Fed has to respond because we're down 30% and they have to do 0.50 or 0.75 or whatever. And that's just what I'm getting at, is it just seems like it's all being put into play across the world. So that means that all world leaders are in on this.
There's a way to get around this, but it's not pretty.
It's not pretty either way then.
The last time, basically, we were in a recession, a major recession. We call that the Great Depression. And how we got out of it, we had to go to war. Basically, that meant lots more oil for lots more ships, lots more munitions, lots more metal, lots more steel, because basically you put everyone to work building these things for war, and you get out of a recession. So if you want to avoid a rate cut, you go to war.
Yep. I've hinted to that. I've hinted that a lot of the Fed reports are pointing not to forget about 2008. It's pointing to 29, and it'll be interesting to see what happens there. I mean, we keep hinting about it here on this show, and I don't think we're the only. Well, we're probably the only ones that actually will say it. Probably a lot of people are thinking it, but they're not going to say it because they're paid to say otherwise.
As long as we don't hear it, we're fine.
That's right. Fine. Everything's just fine. All right, let's move on to this. Speaking of here in the U.S., let's talk about credit cards and just household credit. The American citizenry, if you will, not to sound like Monty Python, but our citizenry is record debt. It's 1.4 trillion in credit card debt.
And you know why?
Please tell us.
Oh, it's trickle down effect. It's a trickle down effect. And
you have a problem with Reagan? What are you talking about?
Basically, inflation, right? Inflation has taken over. Companies have not given raises to match inflation. So 100%. Instead of people cutting back, they start using their lines of credit.
Yes.
To basically maintain a lifestyle that they have been accustomed to without the funds to back it up.
Because you got to keep up with the Joneses.
It is. I will continue to hammer this point home, but the vast majority of these economic concerns, especially for anybody that's middle class and lower, is greedflation. Like, it's not inflation, it's greedflation. It is the fact that inflation sits at 3% right now?
Yep.
Is anything that you buy 3% higher?
No, groceries are 40% higher.
Everything is 40 to 50% higher, sometimes 100% in some areas.
I'm not sure if you know, but housing, housing, basically from what you bought to where we are, from 2001 to where we are, almost up 300%.
I know. I'm looking to buy a house.
Just wait. Just
Again,
wait.
I am acutely aware of that. Like it is in especially with interest rates, you think that housing price of 300% plus the 7%, 8%, depending on what you qualify for, it's going to be like 4 times what you would have paid.
Yep, you're going to spend
overall.
1.2 to 1.3 million just to buy a $300,000 to $400,000 house. If it's even worth 300 to 400,000, it was probably worth about 150 about 10 years ago.
Yep.
Well, that's why I was wondering if that's why Buffett sold all his stocks so he can load up on real estate at this point. I don't know, but I mean, I know he bought a lot of T-bills too. So who knows where he's going next?
And yet income levels have not risen by more than 10% across the board.
It's not keeping up as much as they want to tell you it was at one point that it's keeping up and this is the perfect thing. And we raise all these minimum wages and they're all keeping up now. No, not at all. Here's a question about the fourth quarter, and this is why I think everything really points towards that. I mean, it's October through December is going to be just. I mean, I don't know if I have enough popcorn at home, but the banks, are they going to loosen up their credit? I don't think so. The credit card delinquencies, by the way, we're near 10%, which is like the highest it's been since.
I thought ever. Or maybe
was it ever? Yeah. So, and the government depends on us spending credit because we're a credit country, and that's our biggest thing is we have to put ourselves out there and stretch ourselves to drive the GDP and the economy here in the country, right? I mean, that's what we are. We're a credit country. So. Just a few things here as far as numbers. The average credit card APR, and I know this because I get about 4 a week, people begging me, and I get to see all these banks that I know and love just so much, and trying to get me to sign up for their credit cards. Most of them are in the 28 to 30% is what they're offering. Maybe I'm telling a little bit about my credit, but the average credit card APR right now is about 21%, and that's a record. Because the previous record was 19%, and that was in 1991. Mortgage and auto loan balances are continuing to rise, and people are not keeping up with prices because of inflation. It's just and then you got to talk about the lag effect. I mean, sure, it's happening now, but then what's going to happen 6 months from now? And while the TV's telling you that, and the media is telling you that, well, we just got to get over this hump and then things will look really rosy in 2025. I'm thinking, no, that lag effect's going to make it rough then too. And we might be looking at 2026 to get out of this.
Yeah.
I don't know. So what do you think, Royce?
So there's a lot of basically, and I hate to keep talking about 2008, but there are a lot of parallels that are basically out there, both for credit and the derivatives that they found for credit. Have either of you heard of the DSCR mortgage versus a conventional mortgage or a FHA mortgage? DSCR stands for debt service coverage ratio. Basically, it allows someone without checking your credit, you can form an LLC, put 20% down, and as long as you have the 20%, and as long as you have a renter for the house that you're trying to put out there, as long as what you charge for rent will cover the mortgage, you qualify. So they're, like I said, they're creating new tools and basically ways to say, no, okay, the interest rates are crazy high. Doesn't matter as long as you have a renter that's willing to pay the price, right? So they're literally passing the buck. You don't have to go through nearly the lengthy process of underwriting. You just show up with 20% of the value and someone ready to rent, and the house is yours.
Yeah, we got really creative in 2008, didn't we? So here we go again.
Yeah, but surely there has to be a qualification of like rent to mortgage ratio.
Yeah, that's what they're using. They're basically the expenses of the house versus the person that basically you're putting in there. All you have to do is show up.
There'd have to be a certain percentage because when you start factoring in like vacancies and things like that, I mean,
yeah, you have to have a renter. If you don't have a renter, it won't work.
No, yeah, but I mean, the renters are always going to have some sort of turnover. You're never going to have 100%.
Absolutely.
You're never going to have 100% occupancy.
But that's why you do it through a business, and that way it doesn't hit your bottom line.
No, I just meant the mortgage servicer would have to have some sort of qualification for what the rent to mortgage ratio is. Like you'd have to be making 25% on top of whatever it is, because you look at like a $1,500 a month rent and you're at like 1150 mortgage, you get 2 months of vacancy and you've wiped out pretty much your entire year.
How so?
Well, because you're only making
2 months. You got 2 months where they're not there, but what they're paying, basically, like say for example, I'm going to use just round numbers. Let's say you have a $200,000 house, right?
Okay.
And let's say that $200,000 house is, like I said, about $1,500 a month. As long as the renter is able to pay that $1,500 a month, you qualify. You put $40,000 down, and basically they give you the house, and the renter then begins paying the mortgage for you, and you just basically are the landlord and are responsible for the upkeep of the property. But the person renting, as long as they cover just the value of the mortgage each month and it eclipses it, you're fine. Because it literally, if you can't qualify for an FHA loan and you can't qualify for a conventional loan, but you do have the 20% to put down, you can do this, and guess what? They usher you in.
Yeah, I'm gonna have to look more into that, because there's some things that don't make a ton of sense about that. And so that then just to parallel to your original point, going back to 2008, that's getting into stupid lending practices and
derivatives that basically, it's like, who approved this? Who thought this was a good idea?
Before, when we were doing zero down mortgages and things like that, and that's just that one surprises me if they don't have some sort of rent to mortgage,
and basically that DSCR basically just pays attention to the cash flow of the property itself. Nothing else is factored in.
Gotcha. Well, I did hint a little bit about Warren Buffett going to all T-bills, and he has more T-bills now than the U.S. Treasury has. So we are now the United States of Buffett. It's a literal buffet for Buffett.
That was horrible.
Yeah, it was, and it was terrible, and I didn't prepare. But my point there is that he said that he would go to T-bills. He said this in the past in times of trouble. So he knows
is it
something.
time for trouble? Are you ringing the bell? Are you pulling out the canary? Is it dying?
I mean, he's doing it. He's evidently ringing that bell. I mean, something's going on that is not part of the narrative in the media right now. So it's just like been a whole media
thing. Kiyosaki, the rich dad, poor guy, rich dad, poor dad. He basically also sent out a warning. I subscribed to his newsletter, and he's like, be prepared. This is about to get really, really ugly.
Mm-hmm. I've seen a lot of that. I really have. Not as much, of course, as all the people that everything's fine. Nothing's wrong here. Nothing's wrong.
I think it's like Robert Kiyosaki. I think that's his name.
I mean, even further to that point, again, I'm not saying we're actually headed towards a recession, but there are several warning signs, and that the SAM rule, or SOM rule, SAHM.
Yep.
Yeah, the SOM rule. The creator of it said that we were very close to a recession, and it recently just ticked into the positive by like 0.5%. So it has officially triggered what is considered to be, a strong recession indicator.
Yeah.
Guess what? I saw articles that saying
this narrative. Yeah, this narrative that's going to allow us to get that rate cut. If you want that rate cut, that's how we're going to get it. Mother may I.
It's so funny though. They jumped on it. The media jumped on it. They said, will this be the first time that the SOM rule comes up, but a recession doesn't happen?
Unlikely.
That's what they want you to think.
Give me a break, man. Like I said, I've said this in the past, and I'll keep saying is, guys, just go to the Fred reports and just start looking away. Start digging into those Fred reports. They might be the only place left that I can actually believe the numbers that are there. So, and it not only goes 2008, but you can look at 1929 of things, and then you can look at it never happened before things that are in the Fred report. So, by the way, y'all remember the bank term fund that came out? a year ago, that emergency fund that they did for the banks.
Mm-hmm.
Oh yeah.
They're about halfway through it now, and now's when the big numbers come up that they have to pay back. So the next bank ERs are going to be really interesting in the next quarter. So everything is really, really pointing to that next quarter. And I don't want to do a whole segment on that, but probably I should bring it up next week.
We
or
should
something.
do that. We should dive into that next week.
It's election quarter, fireworks, game time.
I mean, it's just everything at once, everything. And now the whole world, not just the U.S., but the whole world. It's absolutely crazy. All right, so let's get to Royce. You have something you're going to show us in your crayons. There's your crayons and charts.
All right, you guys ready for this? Whoa, and I'm sorry, Darren, this is going to hurt your heart just a little bit.
These people don't know what I think about this CEO. Go ahead.
All right. You love him. He's a fine chap, and you love talking about him. So we're talking about Shopify's SHOP. It's currently up about 17.83% just today. So that was a $9.67 move. But look at all these arrows. Green arrow, green X, another green arrow. Why? What's causing all of this green, right? Well, it's actually moving into a very solid buy trend for the arbitrage band on the 4-hour time frame. So the RSI line was sitting at the bottom. Let me turn off a few of these guys just to make it more visible, just in case you can't see everything that I'm seeing. And we're talking about basically that black line is at the very base. The large candle that we got here allowed probability to expand, and then it gapped up slightly thereafter. So about 7 o'clock or so this morning, it gapped up again, could not hold it. It's coming down just slightly, but as long as it can basically hold about the $60 range, we should be good to go. And I'm actually expecting a very strong quarter for a shop. This is the 4-hour time frame. Let's go to the daily time frame to see what else we got. So with all of this doom and gloom and all the red that we saw going into early July, it lost about 10 or so percent, and basically now it's trying to pick it back up and pick up where it left off. Will it make it much further? Let's see. I'm going to turn on 3D so that way we can see where the world ends. And so on this daily chart, with about a 3-month window, it has a potential of potentially making it all the way up to about $73-ish, which also aligns with where the tops are for the lower time frames. So if you're looking to buy shop, make sure you seek out a duly licensed financial advisor before adding this guide to your portfolio. All right, guys, that's all I got for today.
Yeah, I see that channel widening up quite a bit. Of course, that's because it dove down so far, right?
Yep, it dove so far. And basically, one key takeaway from probability and statistics, and I won't stay here long, I promise, guys. The move that the market makes is always opposite of the direction it intends to go. So if you see a sharp sell-off, it's making room to go higher. If you see a sharp rise, it's making room to go lower. So anytime it's a sharp move, it's always a knee-jerk reaction that pushes you in the opposite direction.
Except for meme stocks.
Oh, no. They definitely go up and come right back down.
I'm going the opposite way. Go way down and then don't come right back up.
Mm-hmm.
All right. But yes, I get your point 100%. So Shopify. Okay. Well, that's SHOP. Let's look. That's it. So let's go ahead and get this out of the way. We have is it 4 in a row now?
Yeah.
So, I mean, I think this was a setup. This was a setup.
Whoa.
Because he comes in and brings in this little flimsy little DJT stock. And he came in with a passion because he wanted to see it go down and lose money. And he came in and I don't know. It's like it was a vengeance. He wanted to see DJT go down. So he just passionate all week to see it go down.
I mean, you're not wrong. But no, it was not a setup.
Right. So anyway, the stock last week was DJT. The channels that were given were channels of 3, and he was below 26. And then it was Royce 26-29. And then I was over that because I had no choice. I did. I did go
No,
second.
you like that? I like that.
I did go second now that I think about it. So all week, Royce had it comfortably. It was in his zone.
It was in my zone all week.
Yeah,
and then right before the bell, kaboom.
It
the
dropped
funny thing is-
$1.50 today or
not
something.
right before the bell. It was spent most of the day, and like it almost hit 25.
Okay, but today it dropped. It was $1.50.
No, I saw it at 26, 27 at some point today.
Yes.
And then it basically went near.
So let me pull up the scoreboard. I want to put it up here. And the worst part is
I thought I had won, but apparently what I had said.
That's right. See, what I said was.
What I said was, and then you're like, no, you can't have that. I'm
all right.
oh, okay then.
So here we go. We show here on the screen that Josh has now taken 4 in a row, which surpasses my 3 in a row, which is why I was even wanting to give up one for the Apes just to get off that little streak because I didn't want him to go past my streak. So now he has.
Yay.
And now he's staring at Royce's record, which is 5 in a row.
One more.
So right behind him.
Okay with that. You know why? Cream of the crop rises. Come on, Josh.
So we're gonna have Royce is picking. No. Oh
no, I'm not.
That's right.
I don't pick. I didn't win.
I didn't even think about that because this is a last minute deal. That Josh gets to pick, or he can go with whatever Royce had planned to make it really interesting. Since he's trying to go after
shop. And then
I did shop for my crayons because I'm like, I'm not picking, but I'm going to tell you which way it's going.
Yeah. He had another one though ready for. That's true. That's true. I had Fortinet as a possibility, but it's not either mine or Royce's choice.
Yeah, I gotta gonna go with
he's ready.
Kathy Wood favorite because she's really good at this. And
of course, what is it? Hey, is Daniel on here? What is this, Daniel? What's going on?
All right, what's the ticker?
Kratos, KTOS, and it's topical too because it's a defense and security solution.
Oh my goodness! Why don't you just go to Northrop?
A little bit more volatility here.
Are you sure? Okay.
Is there enough room on that?
So several of these guys are saying 1855 is the bottom without some bounce. And then it goes up to around 22.20. Maybe we can get up to 25, 24 maybe. So there's room about $2 for each. So 1855
18 to 24.
Yep, to 24.55.
I just like to make it easy with the evens, but yeah, if we want to do the cents and stuff.
Well, that way everyone gets the full $2.
Yeah, that's why I was saying 18 to 20, 20 to 22, and 22 to 24. But if just to make it easy, but if
we can chop off the cents, and So if we see it at 24.55, know that he chopped off the cents and no one wins.
So, because now I am in last place, right?
Yep. Yeah, I guess we'll let you have it. Actually, Josh, I say let the person who won decide the fate of the world.
I'll let him go.
We're gonna have this is like Congress. I defer to the gentleman from his basement because that's where he is right now in the standings.
Yes.
Man, I wish I'd. Oof. Man, you have the. I guess you don't have the chart for us to look at. Yeah,
No, it's up there.
Let me pull it up. I didn't pull it up though. Let me look at it because this is important. All right, I see it now.
Maybe.
All right. So, man, the macro might crush this if something happens here over the weekend.
It's going to be beautiful.
Okay, Trump.
Hey, I can change the words on here. I know an embroidery.
You know what? All right. I don't like to do this, but I'm going to go 20 to 22. I'm going to take the exact middle, which leaves above 22 and below 20. For you to decide whoever's going to pick next, I guess.
Josh?
And
you can pass.
So what are you again, Darren?
20 to 22. So you have 20
2
to
1 and
24
up,
or 20 to
or
18.
1999 and down.
Yep.
I'm gonna YOLO this one a little bit. I'm gonna go 22 and up.
Okay.
All right.
Excellent. I
Oh,
like
is
it.
that what you wanted? That's what you
Yep.
wanted? Okay.
Do you not see that red? Do you not see that
do.
red? And do you not see that the buy is in danger at 1844?
Okay.
I'm
That's
very
right.
happy with your decisions.
He's very happy. All right.
That's why
There
I
will
said
be
I'm
no
gonna
check
YOLO it
tape.
a little bit.
No check tape next time.
You chose poorly. No, just kidding.
All right, guys. If the world's still here next week, we're going to have After the Bell next Wednesday-ish. And maybe we'll even have our Singaporean Institute join in next week as well. So we'll have 4 instead of just 3. But this has been fun with just 3. Everyone say goodbye. We'll see you next week.
See you next week.